Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, I came into this week thinking, okay, let's continue on with scanning. I want to show you how to pick the best stocks and continue along those lines. But then the market sold off a little bit, as you know, and this got me thinking about what you need to know now, meaning that you need to take a look at these transitional patterns. And we covered these way back, I believe, in episode 2. So if you can't sleep at night, go back and watch episode 2. And then, of course, the market started improving right around the time this is being recorded. This is Tuesday, election day, November 3rd, 2020. As this is being recorded, market's having a really good rally. So we may have dodged a bullet. So as I'm getting ready to record this, I'm thinking, well, do we still want to talk about this? And the answer is yes, because you need to know these signs and signals for down the road. I'm going to follow up on some mystery charts which will allow you to see the methodology in action. I also want to follow up on positioning for greatness, and then we'll talk about avoiding losing trades in the first place. By the way, housekeeping, I do take requests due to the pandemic and me having to record this show early and the limited time frame. What I've been doing with those requests is I've been covering them in my other webinar, which I do every week on Thursday nights. So see my website, DaveLandry.com, to sign up for that, to bring you questions there. Ideally, submit them ahead of time so I could put a little thought into my answers and prepare any slides that I might need. Speaking of slides, if you want the slides from this show and all the other 50-something shows, 52 shows, just put your information in at DaveLandry.com/StockCharts, and I'll send that right out to you. And in addition to that, I'll give you limited access to the member site where you can take a look at a mini market timing course, some introductory material for the methodology, and I'll also give you all 3 of my books. Essentially, I'll give you a bunch of stuff for free to keep you busy for a while. And hey, you know, if you like things, hopefully you'll stick around. If you do need to reach me directly, DaveLandry.com/contact. Now let's talk about the mystery charts and the methodology in action. So let's follow up on one of the mystery charts. And with that, I want to talk about positioning for greatness. So this is CRSR. It had a pattern I call the first deep retracement at IPO. Now, it doesn't really look like that deep of a retracement, but if you look at the actual price from $23 or so a share down to around 17.5 or so, that's a pretty deep retracement. And again, with the first deep retracement, we're looking for is an IPO to just take off, go kind of straight up, and then have a really, really, really deep correction. Sometimes IPOs get a little bit ahead of themselves. So there's the actual buy. You can see entry at 20, stop at 17, IPT of 23 for a risk of 3, and that's also going to be our initial profit target, 3 points on the trade. So entry is here, stop 3 points away down here. Initial profit target is up here, 3 points above the entry. Now, in this particular case, it triggered on an opening gap. I did cover that in a little more detail in prior shows, so check those out. Also, check out the weekend charts, which you can find on my YouTube channel, YouTube/C as in Charlie /Dave Landry. So we were fortunate in this case where the first day in the trade, it rallied up, or the second day, I suppose, in the trade, rallied up, hit the initial profit target in less than one full day, I guess. And then the following day, it did follow through a little bit to the upside, closing at an all-time high. So in this case, we get our stop up to break even, plus a little bit in trailing that protective stop. And what we do with the stop was we let it loosen up a little bit, often not by doing anything. And the reason we do that is so we could possibly ride out longer term corrections so we can stay with the position for hopefully a long, long time. Now notice that the stock hasn't done much lately. In fact, it's much lower than it was a week or two ago. But as long as we're not stopped out, we're going to stay the course. Now, getting back to the positioning for greatness, we take the initial swing trade stop and we allow that to gradually loosen up over time. And again, that's often by doing nothing. Let's say the market goes up 20 cents, 30 cents, whatever the case may be. We leave the stop where it is. And in other cases, let's say we're blessed and have a 3 or 4 point move higher, then we might only raise the stop a couple of points and thereby letting that stop continue to loosen up. But if you take the somewhat wider stop we have now and you bring it down to where our initial risk was from the entry to the stop, you can see that the stop has begun to widen out a little bit. And this is easier to see when you take the chart out. Now, as I said back when we talked about money management, and I have a complete module just on money management. Unfortunately, that's behind the firewall, but it's pretty cheap to get in to see all these things. But anyway, when I talked about that, this comes directly from a course I did called Trading Full Circle, but it's also in the money management module. What we're doing is we're trying to capture a swing trade profit and hopefully, and I know I just said the word hope, but hopefully position ourselves for a longer term trade. The longer term trades are where the money is. There's a big caveat though. Unfortunately, that's where the risk is. You're also going to be very low in your accuracy. Some of the famous trend followers have published pieces where they talk about the fact that longer term trends only come along about 28% of the time. And in my own experience, that's fairly reasonable. And a lot of times it's a lot less than that. But that's where the money is. So we positioned with the swing trade, and then we slowly widen that stop out so we can ride out these longer term corrections. Now we're taking partial profits along the way, so the worst thing can happen, barring overnight gaps. I mean, we're not getting into the entire money management plan, but this is the gist of it. We will break even on the remainder of the trade. Now, if we do things correctly, volatility will also increase because the trend begins to accelerate higher once we get in. So if you were just looking at the stock from a volatility standpoint, it could move so far over a short period of time. In general, if volatility stays the same, all things constant, which we know in markets never are true, but it gives us a good little idea of how much a stock can move. So anyway, if we do this properly, then as that trend begins to accelerate higher, volatility increases, and we're able to widen our stop out to ride out that longer term volatility over time. Now this was kind of cool regarding CRSR. 2 weeks ago I did a week in charts where I talked about surviving a drawdown. I didn't do one last week due to the hurricane that passed through here. We're fine, thanks for asking. But I found it interesting that one of my clients put in here, I was in a drawdown into CRSR, and that illustrates the importance of catching the occasional outlier, the occasional big winner, and that's what makes your year, or in the case of Craig, it got him out of a drawdown. So I was very pleased to see that in my Facebook group. Now let's do a couple of mystery chart reveals. This stock took straight off, looking pretty good, took off straight up. Nice little deep retracement. There's that first deep retracement pattern in an IPO, one of my favorite patterns. And we have an entry here and a stop down here and initial profit target up here. So anyway, it didn't trigger, and then it just sells off, sells off, sells off, sells off. It goes sideways. And that is Flux, F-L-U-X. As I preach, no trigger, no trade, so I'm going to pass on this one. Now, people say how deep and how far. I don't have an exact answer for that, but if something's a super volatile IPO, then I'm a little bit more lenient in both time and depth of the pullback. And even in a well-established issue, if it goes straight up, then I want to see a much, much deeper pullback for the correction. Now, if you're new to trading, one of the easiest things you could do is use something like a 30-day EMA to help you know whether or not the pullback is deep enough. I found that that's worked especially well this year, especially with a lot of these GoCo stocks. So here's another IPO that was mentioned as a mystery chart. And you can see, once again, fairly deep retracement. I do like the way it kind of faked out higher than came back in. And a lot of times you can enter above that fake out high. I call that a trend pivot pullback. And let's see what happened. Well, it started trading sideways to lower, to lower, to lower, to lower. And it's pulled back significantly, giving up nearly all of its uptrend. So I decided to go ahead and pass on that one because it pulled back too far in time and too far in price. And this particular stock was AMWL. I know it's not very exciting seeing stocks that don't trigger and go up like that CRSR, but this is all part of the game. In fact, it's a very important part of the game, As I preach, it wouldn't surprise me if 6 months from now somebody says that AMWL turd you recommended is now at $4 a share. I bought it at 25 or 35, whatever the case may be, and I'm losing my butt. What should I do? And I'll go back and forth a few times and say, I would never recommend a stock that's going straight down. They'd say, yes, you did. They'll tell me when. I'll go back and look at the archives. It's like, oh, yeah, I remember that one now. It never triggered. So there was no trade. So no capital was put into harm's way. And remember, in trading, you must lose as little as possible. Trading, you do have to risk money, and you do have to go through drawdowns. In fact, as a trend follower, you'll spend most of your time less wealthy. And I borrowed that term from Fortune's Formula, which, if you use Fortune's Formula, you'll probably spend a lot of your time less wealthy. But with trend following, we try to keep our head above the water, make a little, lose a little, maybe get a few swing trades out here and there, at least with my style. And then occasionally, bam, we hit it out of the park, and we get a C, R, S, R, or 2. Knock on wood. Hopefully that one will continue to run. Missing these negative trades like this by following the plan because they didn't trigger really helps out from both a psychological standpoint and a monetary standpoint. There was one more trade that was recommended right around this time that didn't trigger, that I didn't put in as a mystery chart, and that was IPOB. And the pattern is very similar to the ones I just showed in Flux, FLUX, and AMWL. So check that one out on your own. But that one didn't trigger and did pretty much 100% retrace, if memory serves. If you want to go back and see what I talked about before I took the trades, before I recommended the trades, I'm going to go to davelandry.com/archives, and what I'll do is I'll make sure after I get this show published, I'll go ahead and update those archives so you can see some of these very recent mystery charts in there. And that way you could see my thinking at the time. And it's kind of good for me too, if I say so myself. Recently, there was a stock that I really liked, and when I talked about it on that particular day, it's like, I really, really, really like this setup. I know it might not work, but I really, really like it. If you feel that way, if you feel that enthusiasm when you're looking at a chart, then you need to take the trade. If you're kind of feeling mediocre or meh, then don't take the trade. I know that sounds kind of silly, but something as simple as that can help keep you out of a lot of trouble. Now, since the market, at least recently, looked like it was rolling over, maybe we're okay based on today's big rally, but who knows? One day at a time is what I say. I thought now would be a good time to talk about Bowties. This comes straight from my Trading Full Circle course. It also was discussed, again, I think it was the second show, where we talked about trend transitions. So with the Bowties, we're using a 30 EMA, a 20 EMA, and a 10 EMA. And we're looking for these things to come together quickly and then spread out quickly in the opposite direction. So the 30 is greater than 20, 20 is greater than 10, and then flip that around, 10 greater than 20, greater than 30. Now, I use a simple moving average, and by accident, I discovered that it has a really neat relationship with the 20 EMA and the 30 EMA. I know you're probably thinking what party with me. But I do like the 10-day simple average. In fact, on my shorter-term moving averages, I like a simple moving average just to give you the true representation of price. And for the medium-term moving average, I use a 20 EMA, and that's roughly 1 month's worth of trading. And then the 30 EMA is roughly about 6 weeks worth of trading. So short-term, medium-term, and intermediate-term for the moving averages. And one thing cool about the moving averages, as I learned from Greg Morris, when you're using the exponential moving averages, that is that as soon as price crosses above them, closes above them, they will turn up. As soon as price closes below them, they will turn down. Now, the simple is going to have a little bit more lag, but by complete accident, I discovered that the simple, especially the 10-day simple, interacts very well with those exponential moving averages. So here's the rules. I've covered this quite a bit. I don't want to spend too much time on them, so you can go in and watch some of those prior presentations on that. But basically, you're looking for a market to have a major low. This is for a buy, or a major high for a sell signal. Now, we recently had a major high, and we're going to talk about this particular sell signal, which we may have dodged, but we'll find out over the next few days. But anyway, after a major low, we're looking for the moving averages to go from downtrend, proper order. And I'm going to show you that on the chart, and this is all available on ACP, and it's easy to see. 2, thanks to the little indicator they built for me. So getting back to the rules, after a major low, the moving averages must go from downtrend proper order, 10 simple less than 20 exponential less than 30 exponential, to uptrend proper order, 10 simple greater than 20 exponential greater than 30 exponential, over a short period of time. And ideally, you want to see that happen over 2 to 3 days, and that'll make a lot more sense in the charts. The stock, or whatever other market you may be trading, must have at least a 1-bar pullback. And you're going to go long above 2, or on the short side, you'll go short below 2. And again, that would be after a major high. So this is what it looks like in a chart. Even though the stock is sort of to head higher, the moving averages are still in downtrend proper order, meaning that the 30 EMA is greater than 20 EMA, and the 20 EMA is greater than 10 simple. Notice they come together at what I call a fulcrum, and this is a very tight crossing. This happened over 2 or 3 days, and that's ideally what you want to see. And I'll talk about what I call the sloppy bow ties in a few minutes, and that'll make a little more sense too. But ideally, you want them to be nice and tight at a fulcrum point. Now, once the moving average is crossed over, that suggests a transition or turn in trend, an emerging trend, if you prefer. We're looking for a 1-bar pullback, and we're looking to get long above that high on a trigger. And you might want to give it a little bit of wiggle room to avoid getting triggered in on noise alone. So this is what it looks like in a chart. If we go back to March, it was really cool, kind of a textbook type of signal. And for the most part, the 10 was greater than the 20 was greater than the 30. And that's what I call proper order, uptrend proper order. So in the bottom histogram, it counts the number of days that we have uptrend proper order, meaning that, again, 10 simple greater than 20 exponential and 20 exponential greater than 30 exponential. And then if they begin to cross one another, in this particular case, the 10 crossed or went down and kissed the 20 exponential moving average, then it turns yellow, meaning that they're no longer in proper uptrend proper order. But then you can see it went back to green. So for the most part, we were just kind of swimming along at the beginning of the year. Everything looked fantastic. And then what happened? Well, the bow ties came together really quickly and made a tight fulcrum point. So notice that there was very little yellow in between. Yellow is when they're in the process of crossing each other. And then red is when they're in downtrend proper order. And of course, green is when they're in uptrend proper order. So again, it went from green to red really quickly, maybe 1 bar where it took an extra day to cross over. So then we had a higher high and a higher low. We actually had a few higher highs and higher lows, in other words, a pullback. And you look to sell as that downtrend begins to emerge. Now, back in April and May, the bow tie moving averages had a bit of a sloppy crossing. And that's when one crosses over the other, or one meanders back and forth above the other. And they're having a hard time getting into proper uptrend order, and that's illustrated by the yellow in the bottom. But you can see that eventually the market got its act together, and then it went to proper order to the upside. So that's good. And it stayed green for a long, long time. So that was a nice uptrend, obviously, from May forward, where those moving averages were in uptrend proper order. And what's cool about the bow ties is they're a really good trend transition indicator, such as back in February and March, for instance, to say, hey, this market could be in trouble. But they're also good to let you know if you're on the right side of the market. So they're also a good trending indicator. Now, this last little slide we had, once again, even though it was off of all-time highs, it was kind of sloppy in forming the bow tie. Notice that we had some yellow down here. And by the time things turned red, the market had already turned back up. And you can see it quickly turn right back up to uptrend proper order. So when you do see some yellow, think like the red light, okay, caution. And when you see red, just say, uh-oh, we could be in trouble here. And then start thinking about possibly some evasive action. And that's just mostly honoring your stops, obviously, on existing positions. But also maybe being a little selective in new positions. So you can see right as the market was rolling over again, it turned right back up, turned right back green. But then look what happened. We turned red again as the bow ties came together, crossed over to the downside. Now we zoom that in a little bit, and this was all-time highs back in September, as you know. And then again, this was kind of, like I said, the sloppy bow tie where one crosses the other one and the other one takes a while to cross over. And down below, that's illustrated by the yellow. And then it did finally turn red again. But then notice, right as it's turning red, before you know it, the market took right back off and started going up. We had a little bit of yellow that turned green again. And then we peaked out just shy of the prior peak. Now, one of the rules is that you want it to come off a major high. Well, in a case like this, it's kind of a double top. By the way, patterns like double tops rarely work out like they do in the classic textbook on technical analysis. Usually they stall short of the prior high before they roll over, or in some cases they fake out everybody by going just above the prior high and then rolling over. So learn all those patterns, but make sure you have something a little bit more definitive like bow ties or whatever your favorite trend indicator is or trend transition indicator to kind of work into all that. Or in other words, have that bigger picture pattern behind you. So in a case like this, it's like, okay, we've got a possible double top in the works, and now we have a bow tie. So I better take this signal seriously, or at the least I better pay attention. So in this case, again, we went from uptrend proper order to downtrend proper order quickly. There was no yellow in between. And that happened over 1 or 2 days. And then we had the 1 bar pullback with a higher high and a higher low. Now, I get this question over and over again. Can I use bow ties on a 5-minute chart? Yes. Or a 10-minute? Yes. Or a 20-minute? Yes. Or a 30-minute chart? Absolutely. I believe that patterns or fractal, what works in one time frame works in others. So if we go back in the S&P 500, that sell-off we had off all-time highs back in late September, you could see we had a bow tie back then, and notice again we went from uptrend proper order to downtrend proper order really quickly, given that nice tight fulcrum point. And what's kind of interesting in this particular case, the pullback and the trend transition was on the same day. Now, technically, if you read the rules, it says that 1, you want the change in trend, then 2, you want the pullback. But one thing I've learned, I learned this very early in my career, it's designer's intent. So my intent was to look to short a market after it's rolled over, and sometimes you can get the setup on the same day. In other words, the trend turns and then you get the pullback. But notice that it switched from downtrend proper order on the same exact day that we had the higher low and the higher high. In other words, a 1 bar pullback. So that's a little variation on the pattern. So again, it happened on the same exact bar. So the trend turned and you had a pullback on the same exact bar. Now, to the letter of the pattern, okay, following the exact rules, you would wait for 1, the trend to turn and for everything to be in downtrend proper order. And then 2, you would wait for the pullback, okay? So as you can see, it would have gotten you in maybe a little bit later than the other one, but it seems like that was the true move after it finally dropped. Now, speaking of dropping, you can see it wasn't a route lower. It was a pretty bumpy ride lower, but the market went lower nonetheless. Now, one thing to point out here, notice that we did have a bit of a crossing here for a little while. It went from red to yellow to green, kind of a sloppy crossing, but the market really didn't follow through to the upside. And in a case like that, when it's kind of a sloppy crossing, I go back to the major signal, which was off of the all-time highs. And I would consider that major signal still in place until proven otherwise. Now, I'm not going to throw caution to the wind. And if it stays green for a while, then maybe a new trend is developing. But in this particular case, it rolled right back over. Now, at the recent low, it went from downtrend proper order. And again, this is a 60-minute chart. And notice it made a really tight crossing. There was no yellow in between, meaning that it went from 10 below the 20 and 20 below the 30 to 10 above the 20 and 20 above the 30 really quickly, okay? So that's, again, what I call a tight crossing. And it's coming off of somewhat major lows because keep in mind, this is an hourly chart, and 2-month plus lows is still a pretty big deal. So if we look back to the recent little slide on a 60-minute chart after we had that little run higher, obviously, we had kind of a sloppy bow tie. So in a case like this, again, you might think, okay, well, this is kind of a caution sign. It's trying to cross back over. Yep, it's crossed back over. Maybe I need to honor my stops. Maybe I need to pay attention for a new downtrend developing. So again, it was sloppy up here, and you can see it went from green to yellow. It went green for a little bit, and then it went yellow, and then it went back to red. Okay, so at that point, it's not a perfect setup, but we know that the market could be in trouble based on the moving averages being in downtrend proper order. In fact, the longer they're in downtrend proper order, the more we need to pay attention. So you can't ignore that downtrend proper order when it begins to occur. Now, another thing I like to look at, continuing along the theme of the intraday charts, and I like to look at this on the daily chart and a weekly chart too, but I like to look at the Landry light, and that just means that the lows are greater than the moving average. So it just so happens that the 30 EMA has worked out really nicely this year given the volatility of the market, and I would imagine that would continue to work. I don't want to curve fit my data, but it seems to be working pretty good now, and I would imagine that it will continue to work fairly well, and I think it's going to self-adjust to some extent. But you can see, again, we had a nice little uptrend on a 60-minute chart, and then the markets sold off, and we had mostly red, as you can see in the bottom. Had a little bit of green in between, but not much. And then everything turned back green and stayed green for a long, long time. Now, one thing I've been experimenting with, and it seems to test out, and I do mechanical testing. I do a lot of it by hand, but I do some mechanical testing just to see if I have an edge. But I don't actually trade that edge. What I do is I just use it to gain insight to whether or not there is a potential edge there, and then to figure out how to trade around it. So one thing I found, long story endless, is that after about 10 bars of Landry light, the market tends to continue to trend. And you can see, again, we had mostly red, and notice that after 10 bars of Landry light down here, the market sold off fairly hard. Now, obviously, we have a nice little rally today. It's election day, about noon Central Time. You can see a nice little rally. So we've gone back to green because the lows are greater than the moving average. So I hate to use the word hope, but hopefully there's a new trend developing back to the upside. I don't mind shorting stocks, but I would much rather go long, much easier to make money on the long side. You can use patterns intraday. Just a couple of random thoughts on that. You want to pay attention at major and somewhat major inflection points. Now, don't rush out and make drastic changes if you are a position trader, but do honor your stops and do be selective. When you are looking at these intraday charts, it might look like the end of the world, but make sure you're looking at the bigger picture. Every top will have a pattern on a 60-minute chart or even a 5-minute chart, but every 5-minute sell and every 60-minute sell won't turn into the mother of all tops. But it does give you a heads up. So again, I would urge you to pay attention, but be careful that you are as close to the market as you need to be, but no closer. So don't let these signals shake you out prematurely, but make sure you honor your stops on your existing positions and be selective in new positions. Well, I'm out of time. I want to thank everybody for watching. If you have any questions, davelandry.com/contact. If you want the slides, again, from this presentation and all the other presentations, davelandry.com/StockCharts. So thanks for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.